Well, good afternoon. They've closed the doors, so I think it's time for us to start. This is the last panel of the conference, so it's a tough spot to be in. But we appreciate all of you here. You've heard a lot about foreign investment sort of throughout the day. So we're going to drill down a little bit deeper, we hope, and explore the concept a little bit. My name is Jim Fettgetter. I'm the Chief Executive of the Association of Foreign Investors in Real Estate, AFIRE. We're headquartered in Washington, D.C. We've been around since 1989. I've been around almost that length of time because I could never find another job, and so I just kept on doing this, and here I am still. You know, the last panel of the conference, I look at everybody here, and it's sort of like, you know, the hairs on your head. You know, I don't care how many there are or what color they are. I just appreciate every single one of them. So we do appreciate you all being here. I'm going to just briefly introduce each of the panelists, and I think I haven't even talked to you about this, but I think I'll just tell you who you are, what you do, and if you guys would spend a couple minutes explaining your company, what you're doing, sort of give your qualifications for being on this illustrious panel, that would be great. So, first on my left, and I'm doing this so they can, you know, if I introduce you all and then you all go through, they're going to forget your face and they're going to forget who you are. So we can do it this way. All right, to my immediate left is Neil Jacob. He is Executive Vice President of the U.S. for Oxford Properties Group. So
now leave it to me?
Now leave it to you.
Sure. So Oxford is a wholly owned subsidiary of OMERS, which is one of the largest pension funds in Canada. We had traditionally been a primarily Canadian-based company. About 5 years ago, have diversified both into the UK, Europe, and into the US. And so we're about a $65 billion fund overall. We have $27 billion invested in real estate. Again, 3 or 4 years ago, we were primarily 90% based in Canada. Since then, we've diversified and built a base in Europe and the U.S., about 20% in each of those marketplaces. So in the U.S., since then, we've invested about $5 billion in gross capital dollars. I run the U.S. office, have a team of about 20 people, and soon growing to quite a bit more. We've purchased some buildings in Boston that, you know, probably the two most prominent assets we're involved in are Hudson Yards in New York City and in an acquisition from Blackstone of some buildings in the Boston area.
Thank you. Peter Ballin is our next panelist. He's head of real estate investment for our Canadian Real Estate Investment Board. These two guys obviously know each other too, by the way, so we'll have to be careful about that. So Peter, why don't you explain a little bit?
Good afternoon, everyone. I am with the Canada Pension Plan Investment Board. It's a $225 billion fund. We're based in Toronto, but we have 5 offices, including one here in the U.S. and in New York. We're very much still in an expansion mode. We are continuing to add offices. Our capital base continues to grow. Approximately $25 billion of equities invested in real estate. Approximately 1/3 of that is here in the United States. It's our largest market. We're invested in the 4 major asset classes, and we're invested across the U.S., so we're reasonably diversified.
Thank you, Peter. Next on the panel is Quentin Primo, Chairman and Chief Executive Officer of Capri Capital Partners. We're especially going to be interested in hearing what Quentin has to say about some outbound investment that he's involved in, because that also is foreign investment. Quentin?
Well, I'm just pleased to be here. We have 65 billion, 225 billion, 50 billion. You know, I have a piddling 4 billion in U.S. markets here. But Capri Capital Partners is a real estate investment management firm that I co-founded in 1992. We have historically and heretofore invested only in U.S. markets and primarily 7 or 8 large gateway-type cities in the United States. We have a specialty in the multifamily space. We very much like multifamily apartment for rent assets and have been doing that since 1994. And roughly 80% of that $4 billion is in multifamily, large-scale urban investments. And we're based here in Chicago.
Great. Last man on our panel is Roy Chen. Roy is head of U.S. real estate for China Orient Asset Management International.
We have some scary numbers to talk about. I guess I feel we can group together and control Chicago.
Just don't squash me.
Well, compared with this gentleman, China Orient Asset Management, for those of you, most of those you guys probably don't know, we entered the U.S. market 4 or 5 months ago, and but I personally based in New York, Connecticut. I live in Connecticut, based in New York, and I've been here for 14 years. So they hired me to lead up the U.S. real estate investment strategy. We are a asset management company. We were created by Chinese government in 1998 in response to Asian crisis as the China version of U.S. RTC. The difference is that RTC ceased the operation. We continue to grow. There's 4 of us, and our sister companies. So each of us is now a multi-billion-dollar company dedicated to investment, primarily in real estate portfolio. As of last year, we have a $50 billion under management, and our capital sources, our balance sheet money, and also we are owned and guaranteed by Chinese government, specifically the Treasury Department. So I just joked with my friend Quentin that we're not too big to fail, but we can't fail. So, which allows us to raise money from public market, debt market, corporate bond. For the past 12 months, we have a Hong Kong subsidiary, 100% owned by us, based in Hong Kong, China Orient International. We use that to raise as a base to raise money in the international market. For the past 12 months, we raised about $1.6 billion corporate bond, approximately 5 to 10 year at 4%. And so that's our money, a combination of our balance sheet and also the public offering. And the company is very interested in investing in the U.S. We want to be a player here. And we entered, as I said, we entered 5 months ago. We closed 1 deal already in joint venture with Carlyle in D.C. And we have another deal, looks like it's going to happen. So we're building up an office, we're hiring people, and we're here.
Great. Thank you. I'm going to start off with a couple of slides. Well, here we are. These slides, by the way, if you saw Roy March's earlier in the day, these are not nearly as sophisticated. This is very simple. It's the only way I can understand it. This information is from Real Capital Analytics. I'm sure you all know this, but there is a lot of talk today about the big flow of foreign investment into the U.S. And yes, it is coming back, but it is interesting that we, according to RCA, that we still have not reached the 07 level. I think the perception that people have is that, well, it certainly is a lot bigger than it was in 09. So, but you can see that it's clearly growing. 14, of course, is to date. Okay, this is last year's sources of foreign capital into the U.S. As you can see, we have the 2 biggest regions of the world represented on the panel today, so that kind of makes it, actually we have more than half the foreign investment represented here on the panel, so that makes it kind of interesting. The other point I want to show you is this is 2007. So look who were the biggest investors in 2007. This is a kaleidoscope that changes almost every year, and I have these pie charts going back for several years, and it is always interesting to go back and see the flow of capital into the U.S. and where it's coming from. Now, granted, it has been coming from Canada for the last several years, they've been the top investor. When I started this, back when I had dark hair, it were the Dutch, then it became the Germans. So it's a constant changing. So it's going to be very interesting to see how this goes throughout, the rest of the next couple of years. And that's, okay, I'm done with the slides. Okay, so we've seen China and Canada. Can you all talk, let's talk about Canada first. You all have been the biggest investors for the last couple of years. As I said, I've been doing this since the 90s. Where were you then? Some of you were there. I remember back in the oil boom days, there were a lot of Canadian developers that came down in those days. Now, what happened and why all of a sudden have we seen you here and in Europe and elsewhere? What's going on? What changed?
Well, for us, it really was part of the issue in Canada is it's not a particularly large country from a real estate standpoint. So you end up having 5 or 6 key groups, the case, CPP, ourselves, PSP, a number of groups that dominate the marketplaces. And at some point, you have such a focus of capital that you really do need to look to an opportunity to diversify. Quite frankly, ideally, we wish we had done it a couple years earlier than we did. Been better, I guess, to be here in 2007, or certainly 2008. But, you come in when it's appropriate, and from our standpoint, and I'm not sure in those earlier days, it was really more private money, I believe, coming down in those days that had the impact, and certainly a lot of dollars in Texas. I think the players now tend to be more core-oriented players in the kind of real estate they're investing in from Canada.
So did you just all of a sudden run out of product, or did you all of a sudden have too much money?
Well, I had too much money. I think it's, doesn't make sense for anyone. We had 95% of our real estate assets based in Canada. It's just not a big enough country long term, and we're a growing fund. So we're when I joined in the $40 billion size. We're now 65, going to 100 over the next few years. Real estate represents about 14% of that. You come to a saturation point.
14%.
We have a
very
significant focus around what we call our private markets, real estate, infrastructure, and private equity is almost half of the fund. So it's quite a focus. You look at the office markets in the key markets in Toronto, Montreal, Vancouver, Calgary. They're dominated by the same 5 or 6 players, and the concentration risk really becomes inappropriate just too strong from our standpoint. So we made the decision to move outside those marketplaces.
Okay, Peter, what percentage of your fund is allocated to real estate?
So
14%?
yeah, well, first of all, we don't have formal allocation, so we don't do a top-down. It's a very bottom-up process where we just look for the best deals around the world. The U.S., no, we're just talking real estate because naturally we fund invests outside of real estate. The U.S. is our biggest market. We expect it to continue to be the biggest market, but I don't think we should, that in itself isn't that interesting because the U.S. is also the biggest market to invest in. And so if you actually look at the investable universe, well, the U.S. should capture that just because it's big. So then the question is it actually better? And I would say that the U.S. could actually attract much more foreign capital if it was much more friendly towards foreign investors from a tax perspective. So in fact, I don't think the U.S. is capturing as much capital as they really could. I don't know if they want it. There's tax consequences in a way. There's tax benefits that the local pension funds have. So without getting political, there are benefits and reasons for having different taxation for local investors and foreign investors. But I think the U.S. could be attracting a lot more capital. We're here because it's very good. I don't want to suggest that. And when I say good to an investor means, especially when you're a foreign investor, are things like transparency, being able to rely on the legal system, things that we all take for granted. But when you operate in other markets, you're very much aware of how great things are here in the U.S. But I actually think that the U.S. could actually attract a lot more foreign capital. It's a lot more friendly towards investors like us.
But it's not only beyond that. It's also an extraordinarily, particularly in the big market, liquid market, probably the most liquid markets in the world. Maybe the UK, London competes for that. But I think when you look at the key markets here, whether it's a good market or bad market, there can always be transactions. And I think that's, from the Canadian perspective, that's a real advantage of the US.
But I would argue, what makes it less liquid for us is the taxation. We're subject to FIRPTA. Because of FIRPTA, we have to invest through REITs. We have to sell the REIT shares. That makes us a lot less liquid to us. And so while it's liquid in that there's a lot of demand, we actually look at this market as being somewhat less liquid than most of the other markets we operate in. Brazil has no foreign restrictions on our ability to sell. I'm not suggesting there's much as demand, so if we have an office building in a down market, there might be no buyers, where in the US there's a clearing price for everything. So I'm not trying to make the case the US is less liquid than Brazil, but these restraints from a tax perspective actually make this far less liquid than it really should be, given that it is such a big market. And it makes it less attractive.
So on a global basis, for all your real estate investments outside of Canada, what percentage would you guess are in the U.S. compared to the rest of the world?
Probably about 35%.
35%.
Yeah.
So 100% of your outside investments, 35%
Right.
are in the
But
US.
we do not consider ourselves a Canadian investor anymore. We're really trying to. Our mandate is simply to achieve the highest maximize returns without undue risk of loss. And so we don't have any mandate to invest in Canada. In fact, over the last 5 years, we've been a net seller in Canada. We consider it a great market, but it's a very expensive market, and we see our capital achieving high returns elsewhere. So we don't even think about, okay, what's better than Canada? We just look at the entire landscape and say, where are the best returns? The US, looking at that chart, we were very active in 9, 10, and 11, and we have been, other than development, very quiet in the US. We find it's gotten very expensive from our perspective when we look at opportunities elsewhere in the world. So it's a great market. It's our biggest market. It will always be the biggest market, but I think it could be even bigger if it was more friendly towards us.
Okay, just Neil, about what percentage of your outside Canada is in the U.S.?
Well, about half today.
About half.
Yeah, and I clearly, we have the same issues that Peter does in terms of taxation and investing. It's much more complicated in the U.S. for us to invest. There's a drag from a tax standpoint that is obviously a part of one of the elements that we need to deal with.
Right.
We still find it's in a very attractive market like Peter.
Okay, Roy, let's talk about China. We've heard a little bit about it today, but let's talk about it. A few years ago, it was the only people you heard about from China were CIC.
Right.
And that was it. And then now all of a sudden, everybody's talking about the Chinese investors.
Right.
So what happened?
Well, if you look at, you have a big pie. In 2007, obviously, nothing happened, right? And then from 2009, 2010, you start seeing people come in. And the 2013 is a magic year, which I was personally involved in a $725 million acquisition.
13 was a magic year.
13 is a magic year.
Okay, why is that?
In 2013, in Manhattan alone, if you count the closed transactions, you're talking about probably between $3 to $4 billion by Chinese investors. And I personally involved one. I contributed one of them, which is a $725 million acquisition, One Cheese Manhattan Plaza, which is so far the largest single office building acquisition, 100% acquisition by a Chinese investor. What happened is 2007, why there's nothing going on, Chinese investor in US, is they were having a party there. So the party is that, it's a great party, by the way. They're making unbelievable return. And I can give you guys IRR like 50, 60, 70% on average. So I was there 2007, 2005, and to give you pictures, they built 300 units condominium tower, and they sold out in 1 week before it's even built. So they don't really care. So this is a great. That's why I call this a party. Now the problem is 2009 is the defining moment that the financial crisis and what's been happening in China is that clearly there's overbuilt problem and there's oversupply problem. Not in every city, but largely it's very scary. People start to feel like that it's very difficult to do business in China, real estate investment, and primarily residential. The government, central government, are putting a brake on the economy and try to reform that, and especially the lending spree is over. Very difficult to borrow money. The mezzanine loan, for instance, we have a lot of mezzanine loan in China. Today is 18%. And the first mortgage is more than 7% if you can get it. So I guess the music chair sort of stopped and people look elsewhere. Luckily, they have made a lot of money, so they have a lot of cash, which obviously they have to look elsewhere. And America happened to be the place that they feel like they want to take a look at it. So from 2009, 2010, we see people coming.
Yeah.
And I, because me based in New York, my unique background that the Chinese think I'm American think I'm a Chinese. So I think I'm a rock star. So I basically met everybody, or most 90% of the people that from China did business in New York City. I kind of have some connections with them. So
How many people are there? How many Chinese investors, people on the ground in New York City?
a lot,
What I mean, I don't, is that
well,
50, 100,
at least 20.
20?
Each
Okay.
of them very seriously and closed transactions, very
Right.
serious looking. If you slice and dice, they are all different.
Yeah.
And the first wave are what we call entrepreneurs or real estate developers that they came in and just carry a briefcase of cash and buy a property, just buy it. Now that you have more people coming, like us, for instance, we are a institutional capital source. We're the money guys. So, and there'll be more of us coming, which are different compared with the developers and entrepreneurs. So the way of thinking is different, the purpose is different. So, but I think it's a serious player. And well, we have $50 billion, and I was joking about with our company, said, just give me 10% to spend, right? So one of our sister companies already invested in Chicago. They closed a $300 million acquisition, office acquisition in May this year in Chicago. Right.
All right, Roy, I have a question for you. Mark,
Sure.
you hear so much about the Chinese restrictions on bringing money outside of the
Right.
country.
Right.
Tell me how this has happened.
Well,
Because
yeah.
3 years ago, people
It
kept saying
was-
you can only bring 50,000 renminbi out or whatever it was.
Yeah,
So-
it has been, well, had been an issue for a while. That's why, if you look at your 2007 number, that's part of that reason, besides there's a party going on in China. The restrictions on money, controlled currency.
Right.
The government has trillions of dollar reserve. And I think it get to a point that they're saying, what do we care about? So they're sitting on a big pile of US dollar reserve, and if you ask government, I want to invest in US, they give them Chinese currency, they give me dollars. They don't really care about it right now. So
They're just sort of turning their
Right.
turning their
right,
face and saying,
they got enough problem, enough the inflation is very high, the currency control, and because every dollar, it's a controlled currency system. Every dollar U.S. export to China, buy from China, and you pay them dollars, right? So the Chinese exporters receive U.S. dollars, but they actually can't receive that per se. They have to give it to central bank, and central bank give them Chinese currency. So they amass this trillions of dollars U.S. dollar reserve. They're not really making money. So I think that's part of that, and it's also the demand domestically invest over China is very strong. That's actually exactly after 2009 they started to release that policy. Right now it's not very easy, but it's a lot easier.
Yeah.
But for us, we have a Hong Kong-based company. our money is parked in Hong Kong. Once you have money parked in Hong Kong, like a lot of Chinese investors do, that there's no difference.
no restrictions.
You can wire your money within 6 hours or 3 hours.
Quentin,
Yes, sir.
other than Canada and China, where else are you seeing money coming from that might be interesting for us to hear about?
Well, I mean, our largest pot of capital are U.S. pension funds. But as I've traveled extensively in Africa, India, and the Middle East, where we focus outside the United States, it's a trickle, but it's beginning to manifest itself in transactions in the United States. So we're working with an African investor right now that is a very wealthy private investor, and
Bringing inbound capital.
bringing in capital, yeah, diversifying. It's an investor that is diversifying out of the energy business into real estate, entertainment globally. So we're working with him in the United States. We also have a number of Middle Eastern families that we're close to that we're looking at bringing capital in the United States. But it's infinitely more interesting for us to take U.S. capital and global capital and invest in their markets, Africa, India, and the Middle East.
Yeah, we're going to talk about that in
Yep.
just a minute. But
All right.
before you get off the Middle East, you know, we saw a
Let
lot
me
of...
just say this, by the way, that there is an amazing amount of wealth in Africa, a staggering amount of wealth. The world is full of liquidity right now because of the central bank and flooding the markets with capital through buying securities, et cetera. But Africa specifically has billionaires being minted daily. And because of misunderstanding, misconception, because of restrictions in terms of where capital can be invested, it's a trickle that I believe will turn into a much greater flow over the course of time. As investors in any ilk, of any race, any creed, ultimately you want to have your investments diversified. That's the universal theme of reducing risk, is diversification. So Chinese, Canadian, American, African, Indian, ultimately they will all be in the mix.
Quentin, is most of the money private money? Or is there institutional?
There are some major institutional investors in Africa, such as, in essence, the Nigerian Sovereign Wealth Fund. You have large pension funds in South Africa and other very rich countries. But there's just a corpus of capital in the hands of private investors. So you have a number of very notable billionaires in Africa specifically, but there's a host of not so notable billionaires that are sitting on a fair amount of liquidity. Yeah.
Let's talk about some other countries that people are investing in just briefly. The DLA Piper survey listed 4 countries other than the U.S. for capital. And number 1 was Germany, China, Brazil, Mexico. The AFIRE survey that we do every year had the same ranking of the countries: China, Brazil, Mexico, but no Germany. Does anybody have any? What is interesting about Germany as an international place to invest? Peter, you have some ideas about this, I know.
My idea is I'm not sure why. I mean, Germany is it's a very good country to invest in. It's very stable, very low supply. It's very hard to build new real estate, but we don't perceive it as one of the more attractive markets, and I'm not too familiar how it would land up on a top ranking list, to be candid.
Jay, we don't know who answered those questions, but we can't figure it out. Unless somebody else has an opinion about that. Okay, China, Brazil, have you all invested in both China?
We're very active in both China and Brazil.
Okay,
Yeah.
I have a question. If you're investing in China, are you investing in China?
We're not at this point. Right.
If you're investing in China, why are the Chinese investing here?
I want to ask you.
Diversification, probably.
Diversity is
Yeah,
the
yeah,
right
yeah.
answer.
Yeah.
Quentin's question is right, right?
Well, I mean, your growth rates in China are incredible. So if you
Do you invest in China real estate?
Yes. Yeah, we're very active. We're very active in the industrial sector, and we're just getting into the residential sector very carefully. If we look to scale. I mean, we're a big organization. And if you're going to look at the biggest markets, and as I was going back to the U.S., one of the attractive things is simply the size of this market. It's not a coincidence that Brazil is an attractive market. It's growing, but so is Peru at a faster rate, but Peru is tiny. So large investors need large markets. And if you look at, and we deliberately look at not where the largest markets are today, but we look at where the largest markets are in 25 years. And there's no doubt, not even 25 years, that China's going to be one of the largest markets. So if you're going to be a global investor, you cannot ignore the largest markets. Simple as that. And for that reason, while it's fraught with risk going into new markets and challenges and et cetera, we're not alone. The largest global investors are all very active in China, and a lot of them are active in Brazil. Our partner in Brazil is CIC, is one of our bigger partners in Brazil. So the Chinese are, through CIC, are in Brazil, and that's not so uncommon.
Okay, Quentin, you have some interesting perspectives on other places to invest as well. Would you like to talk about that?
Certainly, and let me back up and say that the only way that I can, as a small entrepreneurial firm, compete against these behemoths that are sitting around me is that we have to be obviously a bit more nimble. But if we attempt to invest like they do, we would indeed get squashed. We don't have as much capital. We can't put it out as inexpensively as they can. So as a firm, philosophically, for us to grow, we have to challenge the status quo. We have to think differently. We have to be different. And since I commenced the firm in 1992, we have realizing that back then, whereas we have over $4 billion today, back then we had zero. Okay, so we had to be very creative in December of 1992 to figure out how we're going to grow a business. And back in 1992, we looked around in the sea of advisors, which we fashioned ourselves as. We had a license from the SEC, or a registration with the SEC, that called us an investment advisor, but unfortunately we had no investments, no capital, not much of anything for the first 12 months or so. But we set sail with the idea that, well, geez, if everybody's an equity advisor out there, why aren't there any debt advisors? There's just equity. And we think that the fixed income instrument of what is a commercial mortgage is basically essentially a bond, a higher yield bond, should be very, very attractive to pension fund investors, that even though they also had all the legacy issues that all other investors had back in the early 90s, early to mid 90s, we knew that these investors, whether they liked it or not, would continue to have to maintain diversified portfolios. So yes, real estate could be in a range from 0 to 3% or 0 to 5%, but it would be unlikely for them to simply divest of all real estate assets and get out of the asset class and never return again. So, and we knew that also pension funds enjoyed income and liked fixed income investment. So to make a long story short, we decided to craft a debt advisory firm, one of the few, if any, that were out there at the time. And somehow we got lucky and we got our first account with the state of Connecticut. And we put their money to work, and guess what? We put their money to work in 1994. And poof, we had a significant bond rally at that point in time. So these pieces of paper that we invested in became more valuable than their face. And the real estate market started to come marching back, and hotels and office buildings and things that we were investing in Southern California. No one wanted to invest in Southern California. We put A lot of capital of that 60 million were given in Southern California, the base foreclosures, all this sort of stuff. No one wanted to invest in Southern California. So we were the motherlode of counter-cyclical, counter-revolutionary plays. And so it worked out well. And we then went into multifamily very early in the mid-90s when no one was really investing in multifamily because everyone was doing office buildings and retail and malls. And so we went into multifamily. So fast forward, we looked at the world, and like any firm, we want to grow. And we felt like any organization, growth outside the borders is certainly one very effective way to achieve marginal growth. And we said, geez, if Morgan Stanley can do it, why can't we do it? So we looked at the emerging markets, the Brazils, the Chinas, Indias, et cetera. And to make a very long story short, we settled on Africa, India, and the Middle East. Based on a lot of research, we discovered that those markets actually are linked, and they've been linked for about 1,000 years. Trade, immigration, cultural, religion. You look at a face of an Arab and a face of an African, and you see many similarities, or an Indian, you see many, many similarities depending on where those faces originate from. So we built our case. We did a fair amount of research as a very research-oriented place. And we now have a partner in India, where we are strategically aligned. We've changed the name of the company to Capri Global Capital, India. And they're doing middle market lending. Okay, well, kind of where we started. They're doing middle market lending to a burgeoning market for small and medium-priced businesses and the like that have real estate as a base. Real estate is collateral. Okay, and we're going to put together a fund sooner or later, 100, 200 million to get going. And that's going extremely well. We went into India in October of 2012. And when we went into India, our partner, maybe my partners were saying, why would you do this? The economy is sputtering. The current account deficit is ballooning. The currency is, the economy is slowing. The currency is falling. The administration is also not doing very well. I mean, why would you go there? Well, we felt that the long-term, the secular story of India was quite interesting. So in October 2012, in those economic conditions, we went in. Now, we're harvesting the benefits of going in early. Africa, when we started talking to Africa about to our investors 3 or 4 years ago, again, why would you, Africa, it's a jungle out there. It's literally a jungle. Why would you consider, and there's not even one Africa. There's 54 different Africas. Why would you do that? Well, again, large population, burgeoning middle class. China had already made the bet on Africa and realized that there were tremendous opportunities. We visited. Being an African American, I had a natural affinity for the region. So we went in and we're raising a very large fund right now to deploy in 6 or 7 countries and really more like 10 cities. But these are the types of things that as a small, nimble entrepreneurial firm we can do. Now, without question, all investors on this panel will be investors in Africa without question within the next 5 years or so. And we'll be selling our completed projects that have been stabilized. No, I'm not being facetious at all, but this is, they will bring liquidity to that country. And as the continent matures, stabilizes, as these trends are very evident, absolutely. Maybe start with South Africa, which wouldn't be wise, but start with South Africa and then move to Ghana and Kenya, or East Kenya and Uganda and Tanzania, and then west to Nigeria and Ghana. So there are opportunities across the world. We, as kind of a pilot fish, kind of get there first. And as we develop those markets and grow with those markets, large amounts of institutional capital follow.
I feel like we've looked into the future.
Well, just give me your money. we're taking deposits after the after the session.
All right, let's switch back inbound into the U.S. for a second. That was fascinating, Quentin. This is a question that I don't get this asked as much. I stumble on my words. I don't get asked this question as much as I used to, but if I went to a conference and somebody asked a question, they'd say, well, what cap rates are foreigners looking for? Is that a ridiculous question, or is that a logical question to ask? Is a cap rate different for a foreign investor than it is for a domestic?
No, I agree. I mean, I don't think there's.
All right. I do remember, I'm old enough to remember when the Japanese were coming in. And that was always one of the phrases, well, there's a domestic cap rate and then there's a Japanese cap rate. So I have a question for you, Roy. Is this influx of Chinese money coming in, how is it different from the Japanese coming in the late 80s into the U.S.?
Well, very different. I think it's very different because the investors came to U.S. from China. I always want to slide. They're not have the same face. They're very different. So, as I explained, the first wave are residential developers in China that made a lot of money. The party is over. So they came to U.S. with all the money and their experience in China, which is based upon build and sell. And then when you build, you always sell. So that's their 10, 20, 30-year experience in China. So they haven't really figured it out. The entire country haven't really figured out how to invest in income-producing property. So if you in Manhattan, 9 out of 10 Chinese investors came to Manhattan, look for condominium projects. So, for instance, Vanke, which is actually the largest developer in the world by the amount of sales, and they have
You said Vanke.
Vanke, yeah. They're doing 3 projects, 2 in San Francisco, 1 in Manhattan, combined probably a couple $1 billion overall value. I know them very well, and they said, we don't understand income-producing property. What we do in China is residential, so we do the same thing in America. This is something we can understand. So same thing with Greenland. There's a lady actually working for Greenland here. I don't know, that probably not in this room. And Greenland is working on 2 projects, one in L.A., one in Brooklyn, New York. In Brooklyn, one is huge. It's $4 billion ground-up development. That's what they do in China, residential, build and sell. So for those investors, it's not about cap rate. It's about appreciation. It's about, you build for $100, you sell $200. So it's very simple math to them, right? So
right. You're not talking about yields. You're talking about selling.
No,
building and selling.
They don't really care about yield, and this is what they've been doing in China.
Yeah.
Right. So right or wrong, but that's the fact. But for us, for instance, we are the capital source. We are asset management company. We're concerned about. We're looking for yield. We may do some condominium development projects, primarily with local partners, but we're looking for income producing. Cap rate is obviously very, very important to us. So it depends.
So what's going to keep the new Chinese investors from coming in, from making the same mistakes as some of the Japanese investors made?
When Japanese were here, that's before I was born, so I don't even know that.
that was a cop out.
Well, obviously, they talk about that a lot in China.
Do they?
In our industry, yes. They basically label the Japanese as a failed real estate investor in U.S., and I have a very different opinion of that, as I know for a fact there's some Japanese investors made a lot of money, actually. So there are some failed projects that I think, overblown to a point that it looks like everybody failed, but it's not true. I think that I think the Chinese investors, this wave, we certainly, I think, in terms of source, in terms of scale, much bigger than Japanese, I believe. You know, Greenland, their first deal in U.S. is $4 billion. And it's grown-up development. So I can't think about any Japanese investors did $4 billion development in the U.S. And I think they're more into income-producing property. So whether we're going to succeed, they're going to succeed or not this time, or more successful than U.S. than Japanese, I really don't know. Time will tell.
But the Japanese as well had a very low cost of funds. It's a country that has an incredible savings rate, and so, yeah, they were buying back in the '80s. They were buying New York office buildings for 2% and 3% cap rates, but their cost of money was quite low, and they're long-term investors. And they're long-term. Well, at least they thought they were long-term investors. Daiichi and all the rest of the insurance and other institutions, but. It is, I would think that cost of capital has something to do with cap rate. So,
So there really was a Japanese cap rate.
Yeah, the Japanese are very smart. Yeah, they are very smart. And again, they're investing for quite a long time.
Okay. One more question about Chinese real estate, then we'll move to something else. Everybody's heard about the meltdown in Japanese real estate. Chinese real estate. We've heard about the ghost cities, and we've seen the video of the chairman of Vanka, I think, was talking.
Yes.
Yes.
The 60 Minutes. Yes.
Yes. Yeah. 60
And also
minute.
another big Chinese investor, Soho China, that the lady.
Yes.
It's a couple, the lady.
Yes,
Actually.
right.
They bought a GM building, by the
Right.
way.
So-
also in 2013. But
For you, and this is really for Peter as well, what's the reality, and is all this blown up out of proportion, or is there an impending meltdown of real estate in China?
Certainly, is there a housing
Residential?
bubble?
Is there a
Because
housing,
we
there's a
worry
housing
about
bubble?
Yeah.
the global economy worries about that Chinese housing bubble.
Yeah, exactly.
More than anything else. I think.
Well, I went to China constantly, obviously, this year alone, twice. It just blew me away. On both sides of the highway, you see just constantly the city, buildings after buildings after buildings. And the massive, the scale of condominium tower is just unbelievable. It's like you can easily see like 50 buildings sitting there, and then another 120 buildings here. And the Twin Towers sometimes just like a forest. So yes, it is absolutely a concern that it can't continue forever, obviously, and otherwise you won't see those big developers doing business in the U.S. Right? But I think our friend said you invest in industrial, which is actually a very smart, wise, I think, wise choice, because for years, industrial products have been neglected, and no one cared about building a warehouse. And now, because of e-commerce in China, the retail development, and all of a sudden people realize, geez, we don't have enough distribution center. And that was actually a overlooked sector. But residential is clearly in a very difficult situation. That's why Wanker is doing in the U.S. and Greenland doing in the U.S. So,
Yeah, I do think it's very important that we don't, generalize about China. It just as a country, there's, New York is not the same as Las Vegas, and we know that here. But from
New York
this distance,
is not like the rest of the United States.
that's right. But
New York is like Las Vegas.
maybe a little bit. But and there's different sectors and all that. So I think the risk profiles are very different from sector to sector. The risk profiles are very different from city to city. The risk profiles are very different from partner to partner. We're partners with a very strong industrial player. We've had tremendous success. Things are just getting leased up instantly, way above our pro forma expectations. The returns are higher in China than in the U.S. So presumably it's riskier. So part of that, hopefully, is you're getting compensated for that additional risk. We are dipping our toe into residential because we do think, similar to Brazil, we started that there is a bit of a bubble, and we're taking advantage of the bubble actually in Brazil. We've come in after the kind of a little bit of a disruption in the market. So there, with the right timing, with the right partners, we are partners with Vanke in China. So we think we're with the smartest guys on the block, and that makes a big difference. Our model is not figuring it out ourselves. Our model really is finding the very best local partners because they're usually one step ahead.
Do you invest in dollars or do you invest in local currency?
Always local currency. I mean, we try to.
Wow.
We're local. We really don't think, do we have to hedge our currencies and all that? That's a different issue. But we're local. We are, we're there for the long term. We're not trying to get out. We're now entering India, which has us, to be candid, much more nervous than either of our other emerging markets. Everyone has left.
It's a good thing.
Yeah, and it is a
Really
good
good thing.
And I think Sam Zell was talking about Brazil. I mean, we're so excited that everyone is fleeing Brazil right now because it was a riskier environment 2 years ago to invest in Brazil than it is today, even though Brazil is technically in a recession. We think that's great news because it scares off what we think is kind of the faster money. And same thing in China. We wouldn't mind a little bit of a cooling down period because we feel we're there for the long term, and we don't like it when anything's too well publicized. India, we're nervous. Good news, bad news is no one else is there from a foreign investment
Wait, I'm
perspective.
there. Come on.
Sorry.
What do you mean no one else?
There's not too much capital.
There's two of you.
We're the only dummies in India because it's fraught with risk
Oh my
and
God.
it's
Tons
a
of
tough market. But again, if we look long enough, our model is about finding the smartest partners, and there's fewer of them than us. And so we feel it's very important to start forming relationships. We've done that in Brazil. There's only 3 or 4 great mall players. If you don't form a partnership now, you come into Brazil in 10 years, they're all gone. In fact, they're all gone right now. There's maybe one left that's kind of semi-independent. India, everyone's still independent. They're all looking for foreign partners. And so we think the opportunity of finding the best partners is very, very attractive right now. China it's still available. It's much harder for us to find partners, but they're available. And so depending on your business strategy, it dictates how and when you need to get into the market. If you're partner-driven like us, you have to get in earlier. You have to stay committed to those partners. If you're more of an investor from a real estate perspective, then probably the urgency isn't, it's not like it's the last industrial building today. If you don't build it today, there won't be one in 10 years. But I can tell you, finding the very best residential developer might not be available 10 years, or the best mall developer. And so the timing of investments is very much correlated to your strategy. And it's not necessarily a better strategy, it's just once you have a strategy, you also have to have a implementation and execution plan that is consistent with that strategy, which is why
It's interesting Peter says that because often people put CPP and Oxford as if we're the same Canadian guys. And in fact, we're partners in Canada. We're partners where we have a property company. Our strategy is different. We're going to put boots on the ground and build our own infrastructure around it. CPP's strategy is more partner-driven, almost exclusively partner-driven. So, we look at each other as we can invest together. We don't look at ourselves as competitors. Largely, most transactions.
And you have the organization here in the U.S.
We're building an organization.
Yeah, and you are it.
Yep.
And you do not.
That's
correct?
great, and nor do we aspire to it. And Oxford's our biggest partner in Canada, and
We have a $2 billion plus relationship in Canada. But we partner together. They have mutual respect for our organizations, but it's just a different strategy. And I think when you talk about behemoths, they're all a little bit different. They all approach the business a little bit differently, so the strategies can be quite different at the same time. And an asset or a acquisition that we make, we may have a conversation and say, well, it's not for us, but I understand why it makes sense for you and vice versa. There are opportunities that don't make sense.
I mean, just following on the theme has focused on kind of countries investing, whether it's Japanese or Chinese. I mean, our investment style is closer to GICs, the government of Singapore, than to Oxford's. It's different types of capital, it has different strategies, et cetera. So I would say we're starting to break, call it those country molds. And yes, the Canadian investors do have a bit more of a more, I'd say, active investment strategy than the U.S. pension funds, if you want to start generalizing. But I must say, we don't see that. When we think about our partners, we think about CIC in China as having almost a similar strategy for some of their markets. We look at GIC, we look at Norway, we look at PSP, but we don't look at Oxford because they have more of an operating model in their market. So it's a very different and strategy. I actually don't think one's better than the other. I think they're just different for different types of capital.
So do you see more Canadian investors coming in, or are the ones that we see now, is that it?
There's nobody left.
Yeah, that's the point, yeah.
No, I mean, one of Canada's strengths is that there's large concentrated pools. They figured that out just like the Dutch, that there is benefits to scale. There's downsides. There's less diversification for the stakeholders here in Canada.
It's harder to be an advisor in Canada
Right.
to Canadian groups because they've
Go
consolidated the money
Right.
and they largely control it within those organizations.
We're too small a country to have the same number of pension funds as the U.S., for example. So we have to be concentrated. The Dutch, too. If you could try to be international and show up in Brazil with $25 million, you will not, it's too inefficient. So if you want to be global, you have to be scaled. If you want the highest returns, you have to be global, is our view. So.
We got any questions from the audience? Surely, we have some.
I think we put them all to sleep.
Yeah, I think we did. Well, it's the end of the day. Yes, sir.
I guess for Quentin and Peter to some degree, the investment in markets like Africa, India, where the transparency hasn't traditionally been there. And Peter mentioned, you're taking more risk, you're getting a higher return, but how do you rationalize going into a market where, the laws are not as well established?
Indeed.
They're almost what the government decides they are at any moment.
Well, the laws are established, they just aren't adhered to. In British common law, it's pretty clear, but.
Yeah, how do you price that risk?
Yeah. In India, realizing that delving into that massive country with all sorts of rules and peoples, and I mean, it's just, it's very difficult to navigate $1.2 billion with not the central planning of China, right? We decided that we needed to be more novel. Certainly doing private transactions in India, there isn't a lot of transparency when you're doing ground-up development. Who knows what has happened with respect to how that land was acquired or gotten, and and what sort of risks, what sort of hands can come out of the grave and grab you around the throat. Our model in India is a publicly traded company. So Capri Global Capital India is a small cap, publicly traded company. Okay, and let me tell you, the Securities and Exchange entity, the Central Bureau of Investigation, they have been behind putting more people in jail because of things like the telecom fiasco. Many people in the real estate sector find themselves behind bars. And we have found that it is wonderful operating in India from a regulated, publicly traded platform. It is the essence of transparency. It's the essence of compliance. So everything that we do when we create a small fund to start being a bit more opportunistic, everything that we do will be from this platform, so that not only I have to be aware of what's going on as chairman of the board, but I know that every member of the board, every employee has a heightened sense of scrutiny and a heightened sense of compliance. In a continent like Africa, just quickly, to make a long story short, to Peter's point, your partner, who you pick, is more important than what you do. And picking the right partner in these 54 countries is critical. A partner that we're in discussion with right now in Africa, the fund's going to be $500 million, and we have about 300 million soft circle at this point in time, but we're already beginning talking to partners. And one partner that we are working with in Africa right now, he said something that just music to our ears. He's a multi-billionaire, and he really likes the hotel sector. And he said, listen, when we do business, irrespective of what country, whether Nigeria, Ghana, South Africa, we have a zero tolerance for corruption. Zero. We see it, we head in the other direction. We gave me an example of, well, you know, we bought a big piece of land in Liberia, and, you know, literally the day of the close, wire transfer instructions. And he said, I noticed that all the wire transfer instructions, the $20-some million is all going to Switzerland. So he said, well, so who owns the account in Switzerland? Well, you know, we really can't say, and blah, blah, blah. And to make a long story short, it was Charles Taylor. And they stepped away from the transaction at closing day. So there's also, one last point, there's also a new generation of Africans. The Africa's a very young country, like India, very young country. And there's a new vision. You know, the Mugabes and these kind of guys, they're all dying off. The Charles Taylors, they're being thrown in jail, they're dying off. And so it's more the Ashish Thakkar, you know, young entrepreneur in partnership with Richard Branson, you know, 30 years old, brilliant. I mean, that's the new Africa. And so that's the Africa that we elect to do business with. But finding them is like a needle in a haystack. Your question is quite appropriate.
Yeah. Yes, sir.
Roy, yeah.
Are you affiliated with that sister company, that SID-DAT?
Yes, we are not really affiliated. It's our remote cousin. So
But no intermarriage, right?
no. But we're both owned by government. That's correct.
What has been, or do you see, is there a cultural challenge for, and not for the small Chinese guys who are running out of cash, but for the Chinese institutional investors? And what I think at some point would be the insurance companies and pension
Yeah.
Do you see any cultural challenges for the way they're used to doing business, to either conforming or trying to change the way business is done here in the States?
Absolutely, 100%. I obviously have personal experience, and I've seen a lot of cases, and I have a very close relationship with people that do business here. Well, I don't know why, how Japanese failed. Is that because of timing or their strategy has a problem? Yes, to answer your question, it is a big issue. I think this is the biggest challenge for Chinese investors, particularly for the developers and who have made a lot of money doing the way they used to do. They feel comfortable doing in China. And when they after they come here, this is obviously a more mature market. It's a very segmented market by markets and by property type. So over there, the market is not segmented. The property type is not segmented. So they do everything. They can build a hotel, next day they build an office, then build a condominium tower, they do it all. So I think they underestimate the complexity of the US market, and also a lot of them underestimate that the expertise required in this country to do real estate, and it is a very operation-intensive business, versus in China, it's a commodity business. And you build, you sell, that's it.
Do you think, growing up, I couldn't even imagine 30 years of 10% growth.
Right,
And what that is just like.
right,
And going from that
right,
to where 3% would be.
right. Well,
It must be like walking underwater.
Well, that's why that I've been dealing with them for a few years, and I feel like I have a split personality. So I need to see a shrink. So it is obviously very challenging for them, and it's not really that, yeah, the return here is low, but I often discuss with them that, look, you make 30% IRR there, but your inflation is 15%. So here, inflation is 3% maybe. So, but it's for different purpose. And I think they're beyond that hurdle about the return. And also further that, this couple of years ago, we talked to them about investing in the US, and everything is the issue. Return is the issue, further is the issue. Now, none of this is the issue. Nobody cares about that. So they just buy building, $4 billion, do it. So they're over that already. So now it's determined. We invest in the US, we want to grow business in the US, but the challenge is how to do that. So I think a lot of them are trying to figure that out and haven't figured it out. And I hope they do soon. So, yeah.
Bradley?
Jim, I just want to make a statement relative to the bashing of the Japanese in the 1980s, because I think there's a tendency to think of what happened in Japan, the Japanese investors in the late 1980s, as being a Japan syndrome. But we go back to who was here from Canada in the 1980s, and they were the developers, and no developer in the U.S. lost any more money than some of the big Canadian funds that came down.
Sure. Oh, and why?
They were huge. There were huge losses in Texas, but also in D.C., one of the strongest markets in the U.S. A big Canadian developer lost a big project there. So I think the issue of the 1980s was a timing issue. Anybody who was a player, anybody who invested in the U.S. in 1988 or 1989 before that crash lost money. The Dutch lost billions of dollars, as did the Japanese. It's the same issue we had of those who invested in the U.S. in 2007 and woke up in 2009 and said, whoa, wait a second, I had a big write-down. I think the culture of Japan was not the problem, it was the timing. Yes, they had low cost of capital, yes, they were aggressive bidders, but anybody who wins is perceived by the others to be an aggressive bidder, unless you bought backdoor, quiet deal, a non-market deal. I think this discussion on and off about the Japanese is inaccurate based on.
Well, you are exactly correct, but you do hear that comparison quite a bit.
By people who basically weren't doing it in the 1980s.
They weren't born then, like you and me.
ありがとうございました。
Jim, I'm really apologize. I have to catch a
No,
flight.
Man,
There's
this is
no
the
more
first time a
questions.
panelist has ever left on
That's
me.
right.
Was
Are you
it something I
dismissing a
said?
panel?
One question, send an
know what?
email to me.
I think we're going to end, and I
Good,
invite you all to
perfect.
go out and drink a lot of DLA Piper liquor.